Welcome to Bedrock Business Builders interview of Logan Rankin. He's going to help us talk about financing. He's going to help us talk about how to get prepared for loans. He's going to help us talk about the nitty gritty of really getting what you want while you're investing in different things. Okay, Logan, are you ready for that?
Let's do it.
Marvelous. I'm ready for it. Joe is ready for it. I know that you guys had an interview previously. You can see it on YouTube. It's an awesome interview. It talks a little bit more about your book and the other things that you do, family life, perhaps, because you've got 2 kids. I've got 2 kids. Joe's a grandpa. All right.
I have 3 grandchildren and 1 on the way. So yeah.
So we all want to be prepared to be able to help our legacy, right? Is that what it is? It's all about our legacy in a lot of ways. And you've actually been able to maintain running a very successful business. I heard 2 successful businesses, and you do it within real estate, correct?
That's correct.
All right. Now, how did you get prepared? What?
Yeah.
Go ahead, Joe.
I'm sorry. Yeah, thank you, Logan, for taking the time to talk to us. I really enjoyed our interview before, and so what struck me as, you're down to earth, and you told me your story, and I'm actually halfway through your book, and you haven't even talked about the real estate business yet, which I find impressive. What's the name of the book?
Find Your Financial Freedom.
Okay, I knew that. I just want to. Oh, what a surprise! You have it up there, and I bought it on Amazon. I'm on Kindle. I'm actually reading it. It's a really good read, and I'm looking forward to getting through the rest of it. But you started with a good job. I'm assuming you had good credit, and then you decided that you wanted financial freedom, and you did it the long way, which is going. Most people think they're going to get rich very quickly. They're going to go into business. You decided to go into real estate, and I know in your story you said you had $20,007 in the bank, and you took $20,000 out and made your first investment. So you didn't buy a house for $20,000, so you had to finance the rest of it. So can you tell us about that?
Yeah, definitely. And that deal, I made a lot of mistakes, but I learned as we went. But yeah, I think one of the reasons I got into real estate as an investment class was because of leverage and because of debt. I think debt's a very powerful tool. And I think sometimes there's a lot of financial experts out there that frown upon debt, right? There's a lot of financial experts out there, not even going to name any, that think that all debt is bad debt, and there's no such thing as utilizing debt. But debt is a very powerful tool, and I think debt is not something that should be feared. It's something that should be understood. So for my first property, I put 20% down on a single family home as my first investment property. And I was able to leverage, actually it was 25% down. I think I bought it around 75, 80,000. So yeah, it left me with $7 in my bank account, but I was able to buy a product, right, significantly more than my $20,000 investment. And I think that's where people get confused. Just to compare, this is what debt can do. If you understand how to use debt to your advantage, and you buy a deal that cash flows and that you can run. Let's just say my first investment property was 100,000, right? If I bought $100,000 stock and I bought a $100,000 property, and both go up, right, by 10%. Well, that means that I gained 10% of my stock, right? Because I have $110,000. But on my property that I put $20,000 down and went up 10%, now my property is worth $110,000. So $20,000 investment for a $10,000 return is a 50% return on my money. And that's where leverage becomes really, really powerful, because in one investment tool, like a stock, you gain 10%, and in the other one, you gain 50%. And we're not even talking about the tax advantages, and we're not even talking about the cash flow. We're just purely talking about the debt. So I think there's a lot more creative ways to be able to do it. And there's a lot of different ways you can utilize debt too, but that's in itself why debt is so special.
Okay, so I've been doing this a long, long time, and sometimes it amazes me how long I've been doing it, because it went by really quick. But I never heard anybody talk about it in that context, because I'm sitting here to have 100,000 in the bank in stocks. I got to make 150,000, and then have the stocks And then I'll be looking at it, I had a friend who's invested in the stock market, and he called me yesterday. He's like, oh my God, all my retirement money, because it's going down. But you took 20 grand. I was going to go into the other part of this, which is the monthly cash flow. You took 20 grand and you made a 50% gain the first year. I'm not saying that that's exactly what happened with you, but that's another way to look at it. And so you basically use the bank's money to greatly, increase your net worth. What got me was I said, oh, here's a guy who took 20 grand in cash, right? And you had a $300 a month net cash flow in your pocket. That's after taxes, after your mortgage is paid. And I was like, well, that's 3,600 for the year. That's 18% after tax. I mean, that's cash.
Yeah.
That's a pretty good investment. On top of that, real estate goes up. Sometimes it goes down like everything else, just like the market. But over time, it's going to go up. So that's why, real estate is one of the best investments. But what I want to get into is, how did you prepare for this? Because this is what people say, oh, I'm going to go into real estate. And they find a place and then they'll call me and say, oh, I need to get a mortgage. They haven't looked at the credit score. What do you do to prepare to get a piece of property?
Yeah, I think the first thing you need to do is you do need to have some sort of, like, I don't ever encourage somebody just to jump in and buy an investment property but I don't think you need as much skills or expertise as that keeps people from buying it. So it's somewhere in the middle. So what I did is, honestly, the only thing that I did is I read a half a dozen books, read 6 books on real estate. And what I did is in one of the books, I remember talking about how to underwrite a deal. So how do you look at an investment property? How do you find out what the rent should be? Which is not that complicated, guys. Like, you can literally find similar square footages, similar bedrooms and bathrooms in the same city, and figure out what they're renting for, right? Then you have a pretty good idea of what it is. You don't need to be exact necessarily when you're just starting. Then you can also, in most books, they'll kind of tell you how to estimate what percentage of maintenance and repairs are going to go into it. Well, that's pretty easy. For example, I know that in Wisconsin, that if the property is in average condition, maintenance and repairs are going to be about 8% of the gross income. So you plug that in. Taxes, exactly right? You look at what your purchase price is, you multiply it by the local mill rate, and it tells you what you're going to pay for property taxes. And insurance is just what it is. You ask your insurance agent, how much is it going to cost? So you go through utilities, right? Are you going to pay for them, or are the tenant's going to pay for them? For my first investment, it was a single family house. So I passed that on to the tenants. So utilities should be 0. Anyway, I just feel like those are some of the basic things that do you understand how to underwrite for the deal? And then what is that cash on cash or that ROI that you want to achieve? For me in 2013, mine was 15%. And as Joe said, I was able to achieve 18. So it was very easy to be like, okay, this seems like a great investment property. I'm going to go ahead and purchase it. That's really all I knew. Like, I know how to fix the toilet.
That sounds almost too simple. It's like these people go to these $30,000 real estate investment classes. I'm like, okay, just watch this little snippet for 30 seconds. But here's the real question. Okay, so you did your homework, you find the investment property. Yep. Now you got to go for the mortgage. Now you got to get the financing.
So this is where I think people make a lot of mistakes, Joe. And I'm glad you asked this question, because I feel like this is something that I've been able to learn and do really, really well. In the beginning, when you don't own any properties, it is going to be the hardest. Okay. But you should be organized and you should be prepared, right? Most banks, you could read in any books, they're going to ask you for 3 things. They're going to ask you for your last 3 years of taxes, right? And they're going to ask you, and they're going to look up how much you make in your credit score. And then they're going to want to know your PFS, which is your personal financial statement. Okay. So you need to have those together. And in fact, if you're reading my book, for anybody that has read it, you know that I believe you should be updating your PFS, your personal financial sheet, every month, not when a bank asks, which most people do, or once a year. You should be updating it every month, because in my opinion, you should be paying attention not just to the cash flow, your income minus expenses for the month, but you should be paying attention to how much your investments are growing month over month.
Are you watching my YouTube channels?
A few I've seen, but you want to have that stuff prepared for the bank. And then honestly, then once if you have those things prepared and you're able to articulate why this deal is a good deal, you walk them through the same stuff I just walked through 30 seconds ago, then the bank's going to have some confidence in that. But here's the trick. That's your hardest. After that, once you get the property, it doesn't stop. This is so I think like that's the short version of how you get the bank to believe in you, right?
So that's your first property is what you're talking about, right?
Yes. And that's the first step, right? Make sure the PFS is prepared, have your taxes ready to go, make sure you can talk about the deal, and present yourself well to the bank. That's just step one though with your first deal.
Okay, I'm sorry, I know you want to go to step two, but I want to ask a specific question because I just had this come up yesterday. Banker friend of mine called me. He wants to know if I could take on this client and rework his financial, his accounting, because his debt to income ratio isn't what the bank wants to see. So they need to show more income. And there's ways to do that legally with the business. You can capitalize some things. But so he didn't know this going in. Is there like a formula people want to see? Okay, here's my debt. I know you need a good credit score, right?
Right.
But this is something, there's an actual formula that if you know what the bank is looking for, you're ahead of the game.
Yeah, it's debt to credit ratio, and you want to be 125%.
Okay.
What they're looking for. They look for that in real estate and look for that personally, which means that you have 25% more income coming in than what your debt load is. That's where the 125% makes them feel comfortable.
Now, are they looking at, okay, because you're going to get on to the next step where you start building on more properties, but are they looking at your entire portfolio, or are they looking at one deal at a time?
So they're looking at both. So they'll look at your entire portfolio. They'll look at outside of your portfolio, your personal financial statement and what that looks like, which it sounds like this client was talking about. And then obviously the deal itself as well too. So it's really, really important to track your debt service credit ratio. In fact, for me, I track that monthly as well too. So I know right off the top, my debt on my portfolio right now, my debt service credit ratio is like a 209%, which is extreme.
Oh, wow. The banks are probably knocking on your door.
They are. Yes. I have a lot of people that want my deals. But and because that proves that you got so much cash flow coming in that a lot of things would have to go wrong for you not to be able to pay your debt.
Yeah, if you're a bank, you're very comfortable, Logan, to Logan. But now, okay, so now you're onto your second deal, and your financials, your PFS is going to look a lot better because now you already have a piece of property in there. You're showing positive cash flow. Your net worth is going up. So what's the next step? Because it sounds like it should be easier.
It does get easier. Before the next deal though, this is the step that everybody forgets. Once you close on that deal, this is, it took me a while to learn. So this will be gold for your audience, is you do not ever let the bank ask for another piece of information. You write a reminder every single quarter and you update the bank. I pride my banks never ask me for my taxes. I send it to them before they ask. My bank never asked me for my personal financial statement at the beginning of the year. I send it to them first. My bank never asked me for my global financial, my global real estate summary, which is just a summary of all of your real estate, the debt, the DSCR, the net cash flow. I send it to my bank ahead of time. And with specific deals where they finance, if you upgrade anything, you send them pictures. So that I have a reminder, I'm like, okay, what did I do in the last quarter? Oh, okay, I rehabbed one unit. I'm sending the after pictures to my bank, and then I'm sending them like, because of this rehab, I'm now getting $300 more in rent. They're not asking for that information for the most part, but by providing those things on a quarterly or at least every twice a year, so every 6 months, by you doing that, you're building goodwill with them, right? You're showing them that you know what you're doing. You're showing, and sometimes if I have nothing going on, I'll just tell them how good the last quarter was. And God forbid if something goes wrong. This is where I feel like a lot of investors screw up. they'll wait for the bank to ask them, right? I don't, like, get in front of it. Your banker will actually appreciate if you be like, hey, here's what happened. I screwed this up, but I noticed it. I caught it right way. And here's my plan. This plan will have it corrected in the next 30 days. Think about that, right? They understand things are going wrong, but the fact that you caught it before them, and not only did you catch the problem, you had a solution. So I think like financing, put yourself in this institution, right? They're loaning you in the most part, sometimes 80% of the property, which is a huge amount of leverage. So if you want to continue that relationship, you should be showing them why this property is, or why the financing piece of this property is in good hands. And then your second property becomes.
I'm sorry, you sound like a dream client. You know, we have problems just getting a bank statement from our clients. And then I just found out from a client, she's like, oh, I'm gonna open up a storefront. And I was like, wait, you don't have the cash flow to do this. But so question, you only deal with one bank, or do you have a bunch of banks?
I have a bunch of banks.
Okay.
Yeah.
So
banks,
because all the banks are really different, right?
they are. And you need different things from different banks. So as you continue to scale your portfolio, you should be looking at banks for different things. And every bank has a niche, right? Usually there's not a bank that can do everything. So I have different tiers of banks. I like a initial bank, a middle bank, and then my end game bank. And I look at them for all different reasons.
Okay, great. So now the second deal, you go, how long was it after your first deal? Did you do the second?
12 months. Took me an entire year to buy the next deal, and then I bought a duplex. So I went from 1 unit. The next year I doubled and I bought 2 units, which was just one property. And then that got a little easier though, right? Because I've been.
But you didn't have the 20 grand again because you used all your money.
Exactly. So this is where velocity comes in, right? Because I got the $3,600 and then I saved up my money for an entire next year, took the $3,600 plus the amount of money that I had set aside to be able to buy and be able to double.
I just have to tell you, because this is one of the things that you did. You sacrificed.
Yeah.
You saved your money. You were eating peanut butter and jelly. I know that.
Yes.
And ramen noodles. And you drove a car with no speedometer.
That's exactly.
And then
right.
you rode a bicycle when the car broke down. I'm like, okay, this guy's a trooper. But here's the thing, Elizabeth. That's what Elizabeth tells me all the time. It's like, you got to have your budget. You got to know where you're spending the money.
Yeah, that's exactly right. You got to know, I'm not a big fan of like, there's enough books out there that like talk about budgets and like living frugal and doing all those things. I just think you should be aware of what you want. Like, I mean, you read in my book, I call it the intensity of your vision. I wanted financial freedom more than I wanted to go out to eat every night. Like I wanted financial freedom at a young age. So a lot of people see it as sacrifices, right? Like, you know, I was making over $100,000 a year when I was riding my bike to work, when I didn't have a speedometer, right? It would
have been easy to go and buy a car.
Easy. Yeah. But what was I doing? I was going broke in a different way. I was going broke by taking all my money and investing it into investment vehicles that in return gave me more money, which I was speeding up the wheel faster and faster, closer and closer to financial freedom.
Can I be honest with you and transparent here? I'm driving a Honda and I'm like, you know, my cash flow is going up. I really want to have a Escalade. And I'm thinking of you, I'm like, wait a second. Yeah, I could do that, but
you could write that off though, Joe, if you need to, right?
I don't need any more write-offs. I need the cash. Because I'm going to be investing in real estate now. I've been talking about this my whole career. I'm like, you know, I tell my clients they should be doing real estate, but you're making it easy. You're making it, well, not easy. You're making it simple.
Yes.
So now you're going for your second property.
A lot easier because you talk to the bank. They've saw all your success with the first property because you've been updating them. The property, obviously, if you did a great job like mine, you know, is producing 18%. I think the DSCR was around 150%. So in good shape. So they trust you to be able to do another one. And that's the thing, like a lot of people, like it's a lot tougher to jump into, you know, with no properties, jump into a 10 unit or a 20 unit. Or I mean, going from 1 unit to 2, I mean, that's not very scary for a bank. Because again, you should, The best way to get as much financing as possible is to build credibility with the bank, right? Prove yourself to the bank and put yourself in the bank's shoes. So I knew too, I didn't have enough money anyway. So buying 2 units was the most I could do, but I also knew that I could do other things, right? Because at this time I had a lot of people like, Logan, I'll go 50-50 with you. Like,
Oh, they want to partner with you now.
they want to partner with me.
A whole nother deal.
Yeah,
Were you nervous? Were you nervous going to the bank for the second deal?
I wasn't. No, I think like what happened after the first deal, I felt a lot more comfortable with the second deal because I've been through it. And the third deal, I was even less nervous. And the fourth deal, I had that much more confidence. You gain more confidence by going through this. And you also gain more confidence in just yourself when you start realizing that you have the ability to be able to manage these well, and that they're producing the returns that you set out to achieve. Side note, Joe, when you underwrite the deal, you always undercommit to the bank so that you can over deliver. It sounds so simple, and it is that simple, but I see a lot of
all the time, under promise, over deliver.
I mean, think about it, right? Because then when I get the second deal, I go to something like this. Hey, you remember when I underwrote this deal, we talked about it, and if everything went well, yeah, I make $3,000 this year. Yeah, I made $3,600. Like, I did even better than I anticipated. I'm sure you're happy about that. I'm happy about that. And I expect to do the same thing on this next deal. So
I'm sorry, but do you go to them like they all have an application? Here, fill out the application, give us 2 years. They're going to ask you for all this stuff. Do you actually go in there with like a package? Here, I already have this. Do you have like your resume and your
yes, I do.
You have a resume in there.
Yeah, I did. I had my resume in there. I had my background history on there. I had my W-2 stuff in there. And then eventually it was less about me. Like when you start acquiring properties, like they don't look at my credit score anymore. They don't even look at like any of that stuff. Now what they look at, if you have enough experience, they're just looking at the deal itself. Like on bigger deals, they don't actually care about you. They care about the business that you're buying. And if you're buying a deal 10 units or more, you're buying a business, not a property. So they care a lot more about that property, and they only care about you from the stance of, do you know what the hell you're doing to make sure that you can run that business at least as good as it currently is, if not better. So then what I provide to them, Joe, is every single year I put together a packet, and all my banks know this, put together a thick packet of every deal I own, every year and how it's performed, my global real estate summary, my PFS, and even my goals for the next year. Like I want the banks to know what I'm trying to accomplish these next 12 months so that I can ask them if they want to be a part of that. And then I can tell them what they need to do to be a part of that. Because at some point in the beginning, it's all about what you can do for the bank. And I still see it that way. They're my best partner. I've never taken any partners. I told you that in my last show. I still own all my equity. I decided to go slower to go faster now. I've never taken those partners, but in a sense I have. The banks are my partners, and I always want to make sure that I'm proving to them that their money's in good hands. But I've kind of put myself in a position now where I do have a lot of banks and financial institutions that want my money really bad, and it allows me to be able to ask for things in a fair way that I couldn't ask for free before. That's your unfair advantage as you continue to scale in real estate, is because money.
They want your deposits.
Yeah, the deposits help too.
So let me put all this in perspective. You bought your first house when?
2013.
Okay, this is 2022, and now you own how many apartments?
I will own in August. I have a pretty big deal under contract right now, a little over 2,500 units and $250 million in real estate.
That's like mind-boggling that you went from having a job, you bought one, that was what, 8 years ago. So yeah. It can be done. It can. That doesn't mean everybody can do it.
Yeah.
Okay. You have, the personality, the tenacity. Also, you have a wife that supported you 100%.
Absolutely.
Maybe not. I know that you bought the first place without telling her. You didn't tell her about, we're going to spend all of our money and buy a house. But yeah. She was like, hey, she was like me. She was like, hey, we can buy a bigger house. And you said, go ahead. What did you say? I'm not going to show you.
Yeah, I think I love that you brought this up, Joe. In my book, I talk about like the alignment of your intensity of vision. And I even say you should put a score on it. And my wife was as intense to be financially free as I was. I don't like arguing with, who likes arguing with their spouse? Okay. So when she said we were making a lot more money and we were living in the same house that we've been living in a long time, which is a fine house. I've never been a things guy, but it's a, you know, a small $100,000 house. And she wanted to upgrade, and there's a nice house for about $250,000. And by the way, we saw a lot of our friends upgrading their houses too. And she saw we're making quite a bit more money, and she just said, hey, I really think it's time to upgrade to the next house. And I said, that's fine. We can definitely do that. Let's look at our goals and let's factor in what the mortgage is going to be if we upgrade to the $250,000 house, and what that impact is going to do for our ability to be financially free. And I did the math, and I don't know exactly, but I think it was like another 2 or 3 years that it would take us to be financially free if we upgraded to that house. So I shared that with my wife. I said, here you go. Like, she's seen my financial plan, our financial plan every month. And I said, we can definitely do it. I just want you to be aware that obviously if we do it, it is going to take us another 2 or 3 years. And if that's what makes you happy, that's what makes me happy. And let's do it. And she took one look at it and she's like, hell no. Like, I will live in this house a little bit longer to make sure to be financially free 2 or 3 years faster. And for her, that was worth it. And I just think like that's a simple concept, but we live in a world of instant gratification and constant distraction with social media and everything else around you. So it's human, right, to want to buy the new car, to want to buy the house, to keep up with the Joneses. And we feel like we're making sacrifices living in our same house. But as I said earlier in this episode, if we remind ourselves that what we really, really want is what we're actually sacrificing, we just don't realize it. And once I asked my wife without telling, like I said, we can do it, right? I didn't say no to her, but I just said, that's fine. We just will have to sacrifice 2 or 3 years longer for financial freedom. And when you put that in perspective, I think there's a lot of people that don't want to make sacrifices today and don't even realize they're making sacrifices for tomorrow. And I think that's where this, like, you're halfway through the book, Joe, so you're probably through most of my steps, but I still do it today. Like, we still, I sit down every month and start step number 1, which is we got to be in a line for what we really want in our vision.
Awesome. So Elizabeth's been listening patiently here, and I know, do you have any questions for Logan, Elizabeth?
I have to admit that you answered a fair amount of questions. However, what types of loans did you use, and what are hard money loans? Because people talk about that in real estate, and it's hard. It's a hard concept, I think, to understand.
Yeah, for sure. I think that both good questions. So the typical, I use a few different kinds of loans. The typical loan or the typical banking or financial institution that I'll use to be able to buy my deals are either local banks or community banks, as well as credit unions. And I do that, guys, because I like to buy deals that are value add, which just strictly means I'm buying the business, but I feel like there's a lot of room to improve the business through spending money on it, like capital improvements, to changing the systems, to making the business, i.e. the property, much more valuable. So for me, I want to use a smaller bank, which is usually more relationship based, so that they'll look at the property and trust what I'm going to be able to do with it, which helps me get a little bit more creative with financing. They also, most of the time, won't charge you a prepayment penalty. And the reason why that's important, because if I can run that business a lot better in 2 or 3 years, I then can refinance that property or that business and take out all my money, plus some, by the way, so that I have no money left in the deal, creating a lot of velocity. And I can take that money, I can put it into the next deal. And then what I'll typically do, with the blessing of the bank, of course, because you want to make sure you're being honest and transparent. No bank wants to necessarily lose debt. As long as you're able to replace that for them and be honest about your plans. And then I like to move it into agency debt. And that's the last step for me. In agency debt, I'm talking about Freddie or Fannie. It's long-term fixed financing. Their rates are way better than local and credit unions. They're usually local and credit unions will only do about 5-year ARMs and 25-year amortizations. A lot of times, if you're experienced, they'll do 30 years for me now. But agency debt, like Freddie Mac, they'll do like 15-year locks. They'll do interest only. Their rates are super competitive. all 30-year amortization. So it's kind of like, but like a great product. And then a lot of times they'll do non-recourse, which means, you take the recourse responsibility off of you. There's one bad part of this though. The penalty for refinancing and the penalty for selling is very, very steep. So you only want to use this kind of financing when you have a stabilized product that you feel like is not, you're not going to add a ton more value. You're just going to reap the benefits of cash flow for the next 10, 20, 30 years. So those are kind of my strategy anyway, for financing. Hard money now. So from hard money, and by the way, I'm actually launching a fund, a hard money fund. And if anybody's interested after this, they can email me at logan@loganrankin.com. It's actually launching July 1st. But hard money is amazing because real estate is really tough when you own it. And when you own the real estate, there's so many different advantages. And you mostly get into real estate for the cash flow. And you definitely, at least that's what I did. And there's ancillary benefits, which we talked about already today, which is obviously there's some appreciation over time. There's also significant benefits tax-wise, which Joe would explain from a depreciation standpoint. But there's work. There's a lot of work with holding real estate. So hard money is basically where you give your money to a hard money lender, somebody that is proven, that has experience. He takes your money and then he in turn loans it out to people that need the money rather quickly and don't have enough time to be able to utilize a bank, for example. Maybe they don't have the credit. Maybe they're a great operator, but they don't have the credit for whatever reason. But the fund manager trusts this person. And basically they loan this person, this operator, the money. A lot of fix and flippers, by the way, who have to close the deal fast and a bank can't close it that fast. They take their money and they close on the deal. They fix and flip the deal. They sell the deal and then they return the money to the fund. The fund takes a small cut from that, and then they return the money to the original investor. So here's the best part. You as an investor are backed by the property. So if something would happen with the property, it's not like a stock, right? Like everybody that has money in their stock market this last month, right? There's no insurance, there's no backing, there's no in first position. You're in first position when you loan, or you should be anyway, if you do it right. To the property. So your biggest risk, right, is if they don't return the money. But the good news is if you loan in states that are investor friendly, you will be able to foreclose, take that property back, and then a good fund manager will sell it, usually sell it for more money, by the way, because they had some sort of sweat equity in it, right? So you actually can make money either way. Obviously, that doesn't happen very often, but if it does happen, I always like to talk about the risk. And the reward, though, is amazing. You basically send one wire, you wait X amount of days until the flip or the real estate transaction is done, and they'll tell you that ahead of time, and you get all your money back plus the interest. And a lot of these deals are, 8% or above, so they sure as hell beat the bank, and you do zero work, right? You don't get the depreciation, you don't get the appreciation, but you also don't have to do any of the work. The fund manager has to. And there's the reason I'm starting a fund though for hard money is because the one thing I hated, I got in this business for monthly cash flow. So a lot of these hard money guys, you give them money and you don't get it back for 6 months. Not that big of a deal, especially if you didn't have a place for it, better than getting taken, inflation eating away at it. So you might as well place it, but you're not getting it back for 6 months and then you get it all back at the same time. The fund that I'm starting with hard money is you actually, all of your money that's in there will actually give you a monthly return for as long as you have your money in there. And then we actually will spread the risk against all the deals versus one deal, which is something I've always wanted to start, because up until this point, every fund that I've ever loaned my money to, because I do this all the time. In fact, I have 13 different hard money deals out there, my money in 13 different deals right now. And because it's a great opportunity to keep your money working hard as you're waiting to buy another deal. Maybe you're not ready to buy a deal, you're still educating yourself. You can still get into real estate. You could put it into a fund like mine, which then would return X amount of money back each month. Like our preferred return is 8%. So it would return 8% returns to you every single month until you wanted the money back, which is pretty cool if you think about it, because again, you don't have to do any of the month. But that's what hard money is. It's basically utilizing your own money to fund somebody else's deal. so that that other person doesn't have to use institutional money, bank, lender, whatever. And it's a lot faster for them.
So this is fascinating. Thank you for asking those questions, Elizabeth. I could see now there are ways to get into real estate. This is one way, you know, I've been hearing about this. Oh, get into real estate with no money down. So I would think if somebody came to a hard money lender with a, you know, no-brainer deal, they can possibly get into real estate. They got to do their homework. It's like you said, it takes time. And I think that's the thing that always held me back from doing real estate. I'm like, yeah, I can do it. I'm going to have to really, you know, for me to do it, I got to get into it. But now, you know what? Another way to get into it is you said, I could just invest into a fund like this. I didn't even know they had hard money funds. So,
Yeah, pretty cool.
yeah, so we're definitely going to have to, you know, connect again, because you have some interesting topics. You're definitely very passionate about this. I don't know, I don't want to say that, but you practice what you preach. Okay, you've done it. You don't just talk about it. Elizabeth, you have any other questions or comments?
Well, I can't have this recording go too late, so I don't have any more questions at this present moment. But I have to say, Logan, that you explained it so clearly. All the different things that you've done and the different steps that you've taken to acquire what you acquired, the financial freedom, and the dedication that you and your wife had to accomplish that. I really think that your level of communication between all of these deals and all the things that you've worked on, it shows. Whether it's you're building that communication with the bank, you're building that communication with your wife, or you're building the communication with the real estate deals that you're doing, and now the hard money lending that you're doing, right? So I'm incredibly impressed and speechless almost. So
it's funny how, you know, it always kind of, there's always like, okay, when you peel away the onion skins, it's like, oh, it comes down to relationships and communication. Right? The relationships with the bank, the relationship you had with your spouse. Not only that, and I want to end with this. One thing that really got me was when you talked about the real estate business, and you said that you want to make it a great living experience, I think, for your tenant. I was like, wow, that's a whole different way to look at the real estate business. I never heard anybody say, oh, I want my tenants to feel comfortable.
Yeah, that's one of my biggest goals right now, guys, is I actually wanted one of the biggest visions for me that I want to disrupt property management across the United States one day, starting with my home state of Wisconsin, because I believe that people pay rent, and they're paying good rent these days. They deserve a place that they can be proud. They deserve a place that's safe. They deserve a place that gives them the experiences that they're looking for. And I think that there hasn't been enough changes in property management over the last 50 years. I think we're very far behind. And quite honestly, there's not enough housing. So I think a lot of property management companies or landlords are just not putting in the effort to be able to deliver that. And by the way, I think you can do it profitably too. I think you can also, you know, not just provide people with a great place to be able to live, but you can do it profitably, because if you're able to deliver on the experience that people deserve, you start building brand equity. And brand equity is worth a lot, and people notice that. So if you're able to deliver, you know, that kind of experience that they were not accustomed to, they're going to continue to come back, and they're going to continue to sign the lease, and they're going to continue to renew, which is a really big deal in this business.
Yeah, awesome. Thank you so much, Logan. If you want to connect with Logan, it's what is it again?
Logan at loganrankin.com is my email. Otherwise, my website is the same thing, loganrankin.com. And you can follow me on all the social media sites. My goal is to give away as much free content as possible this year.
Awesome. And can you hold up your book one more time?
Yeah.
Yes. Find Your Financial Freedom. Highly recommend it. Thank you so much, Logan. And we will be, we'll stay in touch. All right. Thank you.
Thank you.